Know the difference with Annex Wealth Management, and we are sure you have noticed it's an election year. A lot of time between now and November, which means TV ads, radio ads, talk show talk, direct mail, arguments over coffee, all sorts of things. And there's all sorts of myths about what an election does or doesn't do to the economy. How can you make sense of this? Joining us, Tom Parks, Director of Retirement Plan Services, Annex Wealth Management. Hello, Tom.
Hello, Danny.
And Deanne Phillips, Director of Client Learning Development, CFP and CDFA at Annex Wealth Management.
Hi, Danny.
Tom, you point out that we are drinking from a fire hose of media. How bad is it?
Believe it or not, Danny, consumers around the world spend 7.5 hours with media. And I think it's safe to assume that if that's the average around the world, the people in the United States are consuming even more of that. So it's definitely a factor when we look at this stuff.
Deanne, you've been doing this a while, this financial and retirement planning thing. Have the myths always been with us, or are they getting worse or even amplified?
Right. Well, so all these headlines that Tom alluded to inevitably try to link market returns or agendas that affect the economy or investments during elections. And with that, of course, comes a lot of public opinions. Danny, have you noticed that we put more weight into the opinions of those who agree with us? We all do this. We tend to seek out facts that reaffirm our opinions. It's called confirmation bias. We all do it as humans because we need to be right? So relating this to the presidential election, there are these common sayings or thoughts that may or may not be based in fact. We're calling these myths. More of an academic definition, I think, of general assumptions, and they may or may not be true.
One major myth centers around one party being inherently better for the markets or the economy. Well, that can't be a myth. I saw it on the internet.
Oh, well, if it was on the internet, then it has to be true. So a couple things here. One party, which party, I suppose is one thing you could ask. But there is an important distinction that you mentioned, Danny, and that's, you said, better for the markets or the economy. It's very important for people to understand those are two different things. The markets and the economy are related, but they are not the same. The other thing is when you look at one party affecting whether it's the markets or the economy, you've got the presidency, you've got Congress, lots of different combinations of those parties in there. Each one of those is going to have a different result based on how you crunch the numbers.
And that's something we'll talk about during this presentation. Another myth. The stock market can predict who wins the presidency.
The answer is a lot of the time it does seem to, in the very short period of 3 months before a presidential election year. Now, the stock market actually has an interesting track record on this myth. Since World War II, when the S&P 500 falls in the 3 months leading up to the November vote during a presidential election year, the incumbent president has lost the election 88% of the time. Similarly, when the S&P 500 rises during that period, the incumbent has won 82% of the time. So, okay, we have to keep in mind, though, we're talking about a very short period in the stock market, 3 months here, about before the election. But the answer is interesting. Actually, volatility evens out in the 3 months after then.
Another election year myth. I've heard that a divided government is good for the economy.
Well, Danny, based on what I've been seeing in terms of divided government, the economy should be good all the time, right? Because all we hear about is divided government. Kind of alluded to this already in a prior conversation we're having here. There is a variety of ways the government can be divided between parties, all party control throughout, divided within the House of Representatives and the Senate, and then the presidency. All those things are going to have an impact. And so we're going to have to drill down deeper to see exactly which combination of things has an impact.
How about this? Another election year myth. The market is always more volatile near the election.
Yeah, right. So this myth is based on the fact that it's uncertainty before the election that causes everyone's nerves, and that uncertainty causes volatility because it impacts investor behavior again. So it seems likely to increase that volatility surrounding the election no matter which political party wins, with growth anticipated over the long term after, again, no matter which political party is in power.
Bottom line, elections are times when misinformation can proliferate and cause problems. Take your time, sort it out, be careful of confirmation bias, seek trusted resources who can provide insight without bias. Deanne, we got an in-person education event coming together, and it's for Lake Country. Great chance to explore this topic deeply with the help of you and Tom.
That's right. So make sure that you are not perpetuating this myth information, right? It's called Election Year Investment Myths, and it's happening on Tuesday, February the 6th at the Delafield Hotel, East Ballroom, 415 Genesee Street in Delafield. You can go and register online, annexwealth.com, under the events tab.